Ever thought about investing in gold but not sure where to start? Well, you're not alone. The allure of this precious metal has captivated humans for thousands of years, and it continues to be a popular investment choice even today. But gold investment isn't just about stashing away glittering bars or coins in a safe. The world of gold investments is vast and varied, offering a plethora of options that cater to different investor profiles, risk appetites, and financial goals. From physical gold like bars and coins to paper gold such as certificates and accounts, from market-traded gold ETFs and mutual funds to shares in gold mining companies and even gold sovereign bonds, the choices are as diverse as they are intriguing. Navigating this golden maze can be a daunting task, especially if you're new to the game. But fret not, stay tuned as we delve deeper into the world of gold investments. To kick things off, we have gold bullion, the most traditional form of investing in gold. Gold bullion comes in two forms: gold bars, also known as gold ingots, and gold coins. These are essentially gold in its purest physical form, a tangible asset that you can hold in your hand. Gold bars are often what most people picture when they think of investing in gold. They're available in various sizes, from 1 gram up to 400 ounces. The larger the bar, the lower the premium you pay over the spot price of gold. However, keep in mind that larger bars may be harder to sell due to their high value. Gold coins, on the other hand, are more than just chunks of precious metal. They often carry historical or aesthetic value, making them a favorite among collectors. Coins can also be easier to sell than large bars, as they can be sold individually. Now let's talk pros and cons. The main advantage of investing in gold bullion is its tangibility. Unlike other forms of investment, you have physical ownership of the asset. This can provide a sense of security, especially in uncertain economic times. However, this form of investment also has its drawbacks. Storage and insurance can be a concern. After all, you can't just keep a gold bar under your pillow. You'll need a safe place to store it and insurance to protect against theft or loss. Additionally, gold bullion doesn't generate income like stocks or bonds. It's a store of value, not an income-generating asset. This means that the only way to profit from your investment is if the price of gold increases. And let's not forget about liquidity. While gold is a universally recognized asset, it might not be as easy to convert into cash as you might think. Selling gold can sometimes be a slow process, and you may not get the exact spot price when you do decide to sell. All things considered, gold bullion, in the form of bars or coins, can be a solid foundation for your gold investment portfolio. It's tangible, it's finite, and it has stood the test of time as a valuable commodity. Scene script. Next up, we have gold certificates and gold accounts. Imagine owning gold without the worry of keeping it safe. That's what gold certificates and gold accounts offer. They are forms of gold investment that don't require you to physically hold the gold. Let's start with gold certificates. These are essentially proof of gold ownership. Issued by a gold producer or a bank, a gold certificate states that you own a certain amount of gold stored at a specified location. It's like holding a title deed to a house, but for gold. You own it, but you don't need to worry about storing it or keeping it safe. Gold accounts, on the other hand, are accounts that hold a certain amount of gold for the account holder. It's similar to having a bank account, but instead of money, it's gold. You can add to your account or withdraw from it, much like a regular bank account. Each of these methods of investing in gold has its benefits. They offer convenience, eliminate the need for storage, and reduce the risk of theft. However, they do come with their own set of drawbacks. There's the risk of the issuing institution going bankrupt, and the lack of physical gold means you can't use it in emergencies. Gold certificates and accounts offer a more convenient way of investing in gold without the need to store physical gold. Moving on to the world of securities, we have gold ETFs and mutual funds. Picture this: you're at a dinner party and the conversation turns to gold. No, not the gold necklace your friend is wearing, but gold as an investment. You hear terms like gold ETFs and mutual funds thrown around. What are they talking about? Well, let's demystify these terms. Gold ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product traded on stock exchanges. They offer you a way to buy gold on paper. You don't have to worry about where to keep the gold or whether it's authentic. Each unit of a gold ETF represents ownership of a certain quantity of gold, usually 1 gram. The ETFs are backed by physical gold, so the price of the ETF shares tends to closely track the price of gold itself. On the other hand, gold mutual funds are investment schemes that pool money from various investors to invest in a diversified portfolio of gold-producing and gold-related companies. Unlike gold ETFs, mutual funds do not give direct exposure to gold, but invest in companies involved in mining, processing, and distribution of gold. So, what's the advantage? Firstly, they offer a safe and secure way to invest in gold without the hassle of storage and insurance. Secondly, they provide liquidity as they can be bought or sold at any time during market hours. But hold on, every coin has two sides, right? So what's the catch here? The value of these investments is directly linked to the price of gold, which can be volatile. Also, there are management fees and operating expenses associated with these funds. Remember, it's essential to do your homework and understand the risks before diving in. Gold ETFs and mutual funds offer an easy way to gain exposure to gold without owning the physical asset. So next time you're at that dinner party, you can confidently join the conversation about gold investments. Now, let's venture into the exciting world of gold mining stocks. Gold mining stocks are shares in companies that extract and sell gold. It's a bit like buying a piece of the gold mining action without having to don a hard hat and start digging yourself. These stocks can be a lucrative investment, offering potential returns that can sometimes outpace the price of gold itself. Here's how it works. When you buy gold mining stocks, you're essentially buying a share of a company that mines gold. These companies make money by selling the gold they mine. If the price of gold rises, the profits of the gold mining company could also rise, which could potentially lead to an increase in the stock price. However, like any investment, gold mining stocks come with their own set of risks. These stocks are not just influenced by the price of gold, but also by the operational efficiency of the mining company, geopolitical risks, and the overall health of the global economy. So while they can provide substantial returns if the company performs well and gold prices rise, they can also lead to losses if the opposite occurs. Therefore, it's important to do your homework before investing in gold mining stocks. Look at the company's performance, the stability of the region where it operates, and the trends in the gold market. Gold mining stocks offer a unique way to invest in gold by investing in the companies that mine the gold. Last but not least, we have gold sovereign bonds. As you may guess from the name, these are government securities denominated in grams of gold. They are substitutes for holding physical gold. The investor need not worry about storage and security issues like one would with physical gold. In essence, you are lending money to the government for a fixed period of time, and in return, they promise to pay you back the initial investment along with an annual interest. Now let's talk about the benefits of gold sovereign bonds. First, they are safer than physical gold. No need to worry about theft or loss. Second, they offer regular income. Unlike physical gold, which only appreciates in value, these bonds give you a fixed interest every year. And third, they are tax efficient. The capital gains, if the bond is held until maturity, are tax-free. However, as with any investment, there are potential drawbacks. The most significant one is that the returns are linked to the price of gold. If the price of gold falls, your investment value goes down. Conversely, if the price of gold rises, your investment value goes up. It's a bit like a roller coaster ride without the screaming. Additionally, these bonds have a long maturity period. Typically, it's 8 years. So if you're someone who may need to liquidate their assets on short notice, this may not be the best option for you. And lastly, while they are safer than physical gold, they are not entirely risk-free. They carry the risk of capital loss if the market price of gold decreases. But then again, risk is a part of any investment, isn't it? Despite these potential drawbacks, gold sovereign bonds remain a popular investment option. They provide the benefits of owning gold without the hassle of storing and securing it. Plus, they offer regular income and tax benefits. Gold sovereign bonds offer a safe and secure way to invest in gold, with the added benefit of earning an interest. So, are you ready to ride the golden roller coaster? So there we have it, a quick but comprehensive guide to gold investments. We've traversed the golden landscape from the physical allure of bars and coins to the convenience of gold certificates and accounts. We've delved into the world of gold ETFs and mutual funds, understanding how they allow us to tap into the gold market without the need to store physical gold. We've also explored the potential of gold mining stocks, a unique way to indirectly invest in gold. And lastly, we looked at gold sovereign bonds, a government-backed investment that combines the stability of gold with a bonus interest. Each of these investment options come with their own charm and challenges, but remember, the golden rule of investing is diversification. Remember, diversifying your portfolio with a mix of these gold investments can help mitigate risks and enhance returns. Happy investing!